Hi, this class is going to cover technical analysis, and today we'll go over what is technical analysis. It is analysis rather technical, so it's kind of various ad hoc procedure to do forecast prices, and there are many ways, so that's why it's technical. And we will focus on one particular way is technical indicators. And why we want to focus on that? Technical indicators are a systematic way to do analysis compared to other commonly used technical analysis like charting or candlestick. And technical indicators are more easy and more reproducible. So that's why we focus on them. So, what is technical analysis? It's rather technical, so it's not fundamental analysis. So it's not based on fundamental. So it's really some techniques or ad hoc method to forecast the price. So it mainly based on how the past price movement to look at how the future price move. Sometimes use volume, or sometimes use volatility, or those kind of information, but mainly use price movement in the past to predict the future price. And the idea is if in a very short run, the fundamental of the company change, so the past price or price history is most useful to see whether you want to buy or sell, and it's commonly used for people who do day trading or short run trading in the real world. So some of you hear about using past prices to predict future prices. It's a surprise because if you learn efficient market hypothesis, you know even the weakest form would say price history cannot be used to predict the future price, because if there is such a formula, people can use it, the market will adjust quickly because markets rather efficient. And even if only some people would know it, and they would trade very quickly, in the extent that such a mispricing would disappear very quickly. So that is the reason why if you ask many economists, some of them think technical analysis is a superstition, something is not normal, something shouldn't be used at all. And rather on the contrary, practitioner and researcher have been using it, and practitioner have been making money, so I mean must be there's something in it. Indeed, some recent work in the financial literature saying that market is not that efficient, it takes some time for the market to adjust. And some papers said at least would take 15 minutes for market to incorporate news. It means in the meantime, the 15 minutes window, technical analysis can be useful, or sometimes adjustment can be even longer, can take several days to adjust. And also, we also know that investors are not really fully rational. Sometimes they're behavioral, sometimes they're not really truly doing as rational as they do. So when it's not fully efficient, there's some way that technical analysis can do things. You can imagine that stock market change from one equilibrium to another, and this equilibrium are determined by fundamental analysis. But from one equilibrium to another one, how it moves may be able to predict by technical analysis. This is where you can make money from that, and that's why technical analysis is usually used for very short run trading exercise. So let's go for what we're going to do do in technical analysis ad hoc rule. So as we said, there are many ways to do it. It's because ad hoc. But we focus on technical indicators. And what technical indicators we're going to do. And technical indicators basically is some mathematical formula to calculate some number based on price. And we focus on the main types. In the real world, there are many types. I only focus on a few of them. And in the practice, there are many ways to use them. And I just focus on the way many people use it. And as many of you may know, in investment strategy, there's a contrarian strategy. Contrarian strategy, which means you do things different from what other people do. So that means the indicator can be used in the opposite way. So some of you may confuse, but we focus on the way that I find most people were using. So the first type of indicator we're going to look at is trending indicators. It focuses on looking at the long run movement of the price. So look at the past price and look at how it moved in the long run. Look at the big picture, big direction. There are several rules. The first one is simplest, the filter rule. Then we look at a more complicated one is a moving average rule. It's a more advanced version of filter rules. And then next one we look at the MACD, the MACD, which is a special version of a moving average. And all of them are looking at the long run movement. And the next type of indicator, we look at the momentum indicator, which focus on short run movement. And the simplest one is momentum or rate of change types, looking at how price move in this recently. And the next one is look at my famous one is the RSI, the relative strength index. Is looking at past how price have been gone up and gone down in the much recent time frame. And the next type of indicator is volatility type of indicator, looking at the riskiness of trade. We'll focus on two channel type of indicator. One is channel breakout. It tells you look at the past price, what price it fluctuate. When you move out of this channel, then probably start a new type of trend. Similarly, we have a Bollinger Band, which is similar to channel breakout, but we have some statistical foundation for it.